Hi, my name is Kate Hennig, and for my honors presentation, I'd like to talk about greedy algorithms, a concept we learned in 222. I'm going to be applying them to algorithmic trading, specifically on my Thinkorswim trading platform, and showing how greedy algorithms allow me to make decisions in order to buy or sell on stocks. So yes, the basic concept of a greedy algorithm is that at any given time, you choose the best option. This best option, or this series of best options at any given time, may not result in the best overall solution. For example, like if you apply the greedy algorithm to a traveling salesman problem, you're going to be constantly choosing the closest city or closest location. And for example, if your closest city is not leading you towards the other cities, you're probably not going to end up with the optimal solution. So the conclusion from that is that greedy algorithms are not always right, but often they get close enough in certain situations. And in the case of trading, they often do help you make a profit. Okay, yes. So in the example that I'm going to show later towards the end of the video, I'm applying a greedy algorithm whose time period is spanned by 8 data points. And these each data point is the time difference between each data point is something that I specify when I look at my chart. And I specify that I believe that currently my chart is specified 1 minute in between each data point. So that means that my greedy algorithm is going to be making its choices based off of the last 8 minutes. Or basically, if my low 8 minutes ago is higher than my current low, I'm going to buy. Okay, here are common trading algorithms, and I'm going to tell you which one I'm going to be going over in this video. So the first one I want to talk about is mean reversion. I'm basically just going to read off my screen here. Based off the principle of that assets in the short term revert to their time-bounded mean value. Mean reversion looks for signifiers of a reversion to the mean and sells or buys depending on the current value. Okay, so to break that down, it's basically that there are certain traits that you specify that are kind of technical, and that whenever you see one of these, you add in a check to that, and whenever that returns true, you say, okay, we need to buy or sell. It's either going to go up to the mean or going to go down to the mean, so we need to react accordingly. So that's one, and yeah, you just respond based off of the stimuli. Then there's arbitrage, which is less, it's an algorithmic technique, only that it has to parse through a lot of data. And that's why you need to, it's not something that an individual can do, because it's not possible to identify the things that you need in order to make arbitrage successful just as a person. So what you do is you have 2 different marketplaces, or more than 2 different marketplaces, and you're constantly scanning, looking for things, looking for products, looking for stocks that are of similar quality, similar type, and a similar value. Like if you took one stock from one market and you moved it to the other market, you'd be able to sell it. You find those, and you buy the analogous stock in the cheaper marketplace, and you take that stock and you immediately sell it in the more expensive marketplace, and vice versa. So you're constantly just scanning data, looking for similar items that you can sell, parallel products, and taking advantage of those short-term price differences. Okay, the one I implemented, which I think is the easiest one to implement, is scalping, which is like day trading on steroids, sort of. It's getting profit as soon as possible. As soon as profit is recognized, less fees, trade is made. Of course, you can broaden your profit margins, but yeah, of course you can broaden your profit margins, but you're still making trades that make you a couple cents. You're not looking for enormous profit margins. This does depend on implementation. So advantages and disadvantages. Let's start with disadvantages. So this does not, algorithmic trading does not account for randomness in the market, like fluke black swan events, though I don't know if that's a very significant con, because me myself cannot account for randomness in the market either. Small algorithmic traders have very little control over the market because you're just not able to insert the same amount of capital as large firms can. So you're really just reacting. When you make a trade, it's not going to have any significant pull over the market. And then it's very much a deterministic algorithm. So you're just taking historical data and making conclusions off of that historical data. So it's very much a greedy algorithm. Yeah. Okay, advantages is that although you have no control over the market, you can backtest. And backtest is basically you take your algorithm and apply it to a stock over a period of time in the past. And you can see how much money this algorithm would have made for you. So you get to instantaneously test your algorithm on the data of the past. So basically you can continually improve your algorithm based off of this historical data that it feeds you. So more likely than not, you're going to be making money off of your current trades following your algorithm if your historical data is showing that you can make those trades with a profit. So basically it's you have strong ability to improve your algorithm continuously because you have that instantaneous feedback. You also know that you have the best value attained at time of purchase because when you automate your trades, you're going to be getting the price that you want instantaneously compared to the lag that a human is going to have when they decide or they hesitate to decide to make a trade. And yeah, also human error is not a factor. That's kind of connected to what I was talking about before. Here's an example of TradingView's greedy algorithm, but not one I actually used because I decided to go with a thinkorswim platform, which uses their own proprietary code. And so yeah, I didn't decide to go this route, but I annotated this. It's following a similar strategy to mine, actually. You have variables that detect your downward and upward gaps. You have the ability to short. You have the ability to go long. Yeah, you have all four options, basically. You have a couple decision variables, and then at the end, you order based off of those condition variables. And as you can see, the script is not very long. It's actually quite approachable for people with coding experience. Here are my citations. The code I'm about to show you is something that it's open source from this YouTuber trading stocks. I made a few modifications to it, but really all props to him. So I'm going to open up thinkorswim real quickly. First, I'm going to look at charts. Right now I'm just on simulated trading. So this is all paper money. Basically, I have three lines here that are made by my code. I have a red buy line. I have a green sell line. I have a blue, well, I have a yellow short line, and then blue is where I buy back my shorts. And then now I'll show you how I actually made these using my think script. Okay. Here's where I specify my open time, close time. Here's where I specify valid beginning and end and good times. You don't want to have these open after the trading day is done. So that's what good time means. This is what I was talking about earlier, is that you define your buy variable based off of if your current low is less than your low 8 time periods ago. And once again, if good time is valid and high is less than selling. Here's your add order, your tick color add order. Here's your short specification. The time period here is a little bit higher. My shorts are actually more reliable on this historically. And then I have my cover, or my low is less than or equal to my low cover sig, and my add orders here. So just to specify, I didn't actually set this up. Actually, it's not possible on Thinkorswim to set up entirely auto-traded. Like, for example, you see my buy and sell signifiers here. It's not going to automatically put these trades in for me. I have to go and buy when I see those sell signifiers, or buy when I see those sell signifiers based off of what my algorithm is telling me. So it's not exactly automated because you're still going to be experiencing that time delay, but it's following exactly a logical process, exactly a greedy algorithm. Anyway, I hope you enjoyed this. I certainly did. Okay, that's it.